Yerke from Ferris State University. I think the most important lesson I learned was about managing your time wisely, working diligently, and working well as a team. I think the biggest challenge that our team faced was the amount of time and how challenging that the valuation of the company was. It did take a little bit more time than we originally had thought, and it was a lot more work than we were anticipating. I think because it was our first time doing the project and valuing a company like this, it was a little bit more challenging, but I think it was an accurate representation of what it would be like, especially presenting to a panel of judges would be a lot like presenting to a board. I've often thought about being a professor in finance and teaching it, so this opportunity of being here, maybe someday I'll be able to bring a group of students.
Good morning. Before we begin, we would like to introduce the Ferris State University team.
Lindsay Yerke.
Brian DeVries.
Corbin Hammond.
John Lampin.
And Liz Schrader. Today we're going to discuss how we derived our target price of $117.92, which led us to a buy rating for Perigo stock, how Perigo implements its first and lasting strategy, and the main risks that we evaluated when we were evaluating the company. Perigo is a global company that operates in 6 countries worldwide to fulfill its founder's vision of providing affordable healthcare products to consumers worldwide. Perigo is divided into 4 segments, which are consumer healthcare, nutritionals, generic prescription pharmaceuticals, and active pharmaceutical ingredients, also known as APIs. The consumer healthcare segment's main focus is on over-the-counter pharmaceuticals such as cold, sinus, and flu care, as well as feminine hygiene and diabetes care. This segment, as you can see, is the largest in both sales and adjusted gross operating income. This segment acquired Can-Am in 2012, which helped boost sales to $14.3 million by enlarging their diabetes care product line. The nutritionals focus is on infant and toddler care, as well as mineral and dietary supplements for all ages. This segment saw lower gross profit in 2012 due to lowering birth rates and a transitioning product line. However, they were recently approved to produce 3 new infant formulas, which should help them recover gross profit to previous levels. The generic pharmaceutical segment produces generic prescription drugs at an affordable rate. This segment saw a higher gross profit in 2012 due to the acquisition of Paddock. The last segment is APIs, which produce active ingredients for both generic and brand name consumers. This segment is currently the smallest. However, over the last 2 years, they've been working to move production sites from Israel to India, which should allow for lower cost of production and also make room for more complex production in Israel. Even though Perigo operates globally and has so many products in all of their segments, they're able to keep their cost of production low by owning production sites in the United States, United Kingdom, Mexico, and Australia.
Perigo operates normally in the generic drug and pharmaceutical manufacturing industry. It is characterized by several characteristics. Amongst those are cost leadership, a growing market share, and recent healthcare legislation. As far as cost leadership is concerned, generics cost between 30 to 80% less than the brand name counterparts with the same active ingredients. And they're also attractive for end users and retailers alike because of their lower end prices for the end users, and they have lower sale prices for the retailers, and they also have wider margins for retailers, which also enables them to have prime shelf placement and higher sales. Another thing that separates the generic industry through cost leadership is their advanced R&D production and significantly less R&D expense compared to brand name competitors. Once these drugs come off a patent, the generic industry has to spend significantly less marketing, researching, and developing these products to get them to market. The generic industry is characterized by having a growing market share within the overall pharmaceutical industry. In 2011 alone, 80% of all prescriptions filled were generics. And there's $290 billion of sales at risk from patents expiring for the next 5 years. Even though the patent cliff has passed in 2012, we still believe that the large sales at risk is a great advantage for the generic industry. Healthcare reform is also huge. Even though margins are threatened to lower end user costs and increase healthcare coverage in America, it will also be augmented by the inclusion of 32 million uninsured Americans. Also, it is forecasted to have $100 billion sales growth from this, which generics is poised to really take advantage of. In summary, cost leadership is the main key driver that really separates the generic industry within the pharmaceutical industry and healthcare. Also, the growing market share and healthcare legislation really sets the generic industry to really see growth and a lot of potential.
All right, in our analysis of Perrigo, we used two valuation methods, discounted cash flow and price multiples. The first method we used was discounted cash flow. In our discounted cash flow analysis, we used free cash flows to the firm because Perrigo has a significant amount of debt. We also used a scenario analysis to account for possible risks. The first thing we did was forecast our free cash flows to the firm using our forecasted financial statements. We then calculated our weighted average cost of capital to use as a discount rate. We used the CAPM model for our cost of equity. Our risk-free rate was a 10-year return on a treasury bond. Our market risk premium was found from Fama and French, and our beta was calculated using 5-year monthly data. We calculated our tax rate using a simple average of the previous 3 years and calculated our cost of debt by taking the interest paid divided by the total debt for 2012. We then calculated the terminal value using the Gordon growth model and a 4% growth rate for perpetuity. We then discounted our free cash flows to the firm and our terminal value at the weighted average cost of capital to get our net present value, and then subtracted off the market value of debt and divided that number by the total shares outstanding to come up with an expected stock price of $117.42 for our base case. We then conducted our scenario analysis by adjusting our sales forecast in either direction and weighting the scenarios based on what we thought was the probability of them occurring. This gave us an expected stock price of $115.59. The second valuation method we used was price multiples, specifically a price earnings ratio analysis. We calculated the PE ratios for the previous 5 years, and then using our forecasted earnings per share, we calculated an expected stock price of $121.42. Then we weighted the two methods, 60% to DCF and 40% to price multiples, because discounted cash flow we found to be more reliable and more relevant to Perrigo. This gave us a final expected stock price of $117.92.
For the financial analysis section, we're going to be covering a SWOT analysis, the debt ratio, earnings per share, liquidity, and some financial highlights. Some strengths and opportunities for Perrigo is for the last 5 years, they have had increasing operating margins every year for a total increase of 6.7%. Also, over the same time period, sales were able to grow every year for a compound annual growth rate of 12.94%. Another strength would be that Perrigo has a successful use of the first in, last in strategy, along with having a very strong balance sheet, which will allow them to leverage the firm and increase into new markets and more products as more patents expire. And also they have a very strong upper management team. Some weaknesses and threats would be that Perrigo always faces pressure from companies like Walmart to try and get them to lower their prices. And also, due to store branding, they have very little customer loyalty because nobody really knows where the pills actually come from. Another weakness would be that their gross margins were 7% lower than their competitor, Watson Pharmaceuticals. And also these margins risk being compressed further by pressure from companies like Walmart trying to get them to lower prices. Their debt ratio over the last 5 years has maintained a relatively low amount, and it has been decreasing as of late. And it just shows that Perrigo is able to leverage the firm and expand into new markets as more patents expire and opportunities exist. Earnings per share have been increasing every year for the last 5 years at a compound annual growth rate of 26.56%. And we expect earnings per share to increase to $5.22 in 2013, which is a 22.14% increase. Perrigo is a very liquid firm, as their current ratio and quick ratio have maintained a relatively high rate over the last 5 years. And it shows that Perrigo is very capable of paying off all their short-term obligations, as well as taking on any short-term obligations that they see fit. Some financial highlights is that over the last 5 years, sales, gross margins, operating margins, net income, and earnings per share have all been increasing, and we expect that to continue into 2013.
When valuing a company, it's important to consider the risks that that company faces. Some of the key risks that Perigo faces are competition and pricing power, increases in the costs, intellectual property risk, tighter regulations, international market risk, and customer relationships. To combat the stronger competition, Perigo implements a first-in, last-in strategy, and by pursuing products that are more difficult to develop and stay with. And for customer relationships, it's important to consider because Perigo has a customer, Walmart, that comprises of 20% of their sales. Now, while no other companies make up more than 10%, it's still important to consider that any changes in this relationship may have a negative impact on Perigo. To help you better understand the risks that Perigo faces, we put together a risk matrix. As you can see, the impact is on the y-axis and the probability on the x-axis. As far as impact goes, you can see some of the more significant risks are changes in legislature and tighter regulations, while the higher probability risks are increases in competition and economic volatility. The keys to Perigo combating these risks are, again, their use of the first-in, last-in strategy, their advanced R&D and acquisitions, as well as their entry into new healthcare markets, which comes to our conclusion. We give Perigo a buy rating with a price target of $117.92, which is a 13.38% upside. Thank you for your time. This is the conclusion of our presentation. May I take any questions?
You talked about on the consumer healthcare side, Walmart being about 20-25% of revenues and no other greater than 10%. Who are some of the other people they're selling to?
Some of their other big clients include like Kroger and Meijer.
And how is their competition? Do they have a large market share in that consumer health selling to these people, or is there someone else barking up on their heels?
Right now, as far as sales as well as company assets with debt, Perigo has about 9.4% of the total market in generic drug manufacturing. Their sales are really strong. Their next leading competitor is substantially smaller in size. However, they're always facing pressures from Watson and other major prescription manufacturers. However, Perigo's thing is a really, really rich pipeline of products. They don't only operate in prescriptions. They don't only operate in over-the-counter. They do everything. What they really like to do is they like to seize opportunities that are capital intensive and hard because they know their competitors cannot do what they can do because they're a very strong company within their industry. So what they do is they have a really rich pipeline that diversifies all of their things. So when you talk about market and you talk about their competitors, they have so many different competitors because they operate in so many markets and different segments. I hope that answered your question. I'd be more than happy to elaborate if you'd like.
That was fine. Thank you.
Question on the business segments. There's consumer healthcare, nutritionals, pharmaceutical, and API. If you were to take each of those business segments separately, would there be different? Would they be trading at different multiples? Is there more value? Is the industry or does the street recognize more value in one segment than another? And in terms of what might be growth drivers for the long-term value of the company, which areas really are going to have the best opportunity to grow and over the longer term?
I would say that the consumer healthcare segment is the largest just in sales and operating income. However, their nutritionals is really heavy. They just got approved for 3 new infant formulas, which with the recent epidemic in China when they were given all of the formula that was tainted, the FDA approval is really heavily weighted for everyone, so it means a lot, especially in the foreign countries, to have the FDA approval, so getting those should really help that segment grow. The API segment is the smallest. Basically, the reason they have that segment is so they can provide themselves with the raw products to make their pharmaceuticals, so that one's not really meant for them to make the most money. So pretty much growth-wise, consumer healthcare and nutritional should be the biggest upcoming segments.
In you guys' free cash flow to the firm estimates, there's a lot of working capital in there. I'm just curious how you came up with that.
In our estimates for the free cash flows to the firm, we based our forecasts on prior years, averages of prior years. So we forecast our financial statements, both for the balance sheet statement, cash flows, and income statement, and then got all of our information for our free cash flows to the firm from those statements. So for the working capital, I believe that we pulled that from both the balance sheet and the income statement. So just from our forecast, what we from our research had decided was the most likely thing to happen.
Yeah, I know too. They also always had a lot stronger current assets than their liabilities too. A lot of areas to expand in the near future.
Go ahead.
Go.
Describe the first in, last in. You mentioned it a couple of times. I don't think maybe I missed it.
Sure. The first in, last in strategy, I mean, it sounds just like an inventory valuation method, but it's really their market strategy, and it's not one single strategy, it's a synergistic effect of two different strategies. So Perrigo wants to be the first to market. They want to get that FDA exclusivity right when things come off patent. They want to be the first one in there. They want to be the first to the retailers. Even if the competition can undercut them, they want to be there first because it is such an undertaking to acquire the brand. In the first place, they don't want to change companies, they want to stay with it. So they want to be first in. Even if it's capital intensive, like I said, they have strong financials, they have a strong diversified areas, they have a lot of business segments with a lot of diversity. They want to be in the ones that are hard for their competitors to enter. For the first in, they get in there first, they establish their market. Last in is the second part. It's not necessarily last in. What they mean is they want to last in their segments. They want to have the competition come in through just basic economic forces. And then when profits and margins decrease, they want to stay in there and just like, they basically want to stick it out through the thick and thin, and they know they can because they have such a diverse pipeline that augments their whole company, even when some segments might fall and have smaller margins. So what they do is they last in there until their competitors leave those markets. And once they leave, they have all the market share, and they really think that they're sitting very strongly. It's a very proprietary market strategy. If you do a web search on it, you're not going to find anything on it. It's something they coined themselves, but I think their CFO really elaborated on it really well when we met with them. So,
in your scenario analysis, it seems like the wins on their back. You have a 15% waiting for worst case and 20% for best case. Talk a little bit about that, and if I buy the stock, what do I have to worry about? What's the biggest concern I should be worrying about to make this change?
Yeah. All right. So with our scenario analysis, the reason why we just weighted based on what we thought would happen. Obviously, we gave the most to our base case because that's what our research suggested to us. But with the best and worst case, we saw a lot more going in their favor than going against them. So we decided to just give a little bit more to the best case, but we didn't want to overestimate them either. So we tried to keep it fairly close. And so that's how we came up with our weights. And what was the second part of your question? I'm sorry.
What would if I bought the stock? What's the most thing the risk I can see that I have to be watching, the footsteps I have to listen for that may change this?
So basically, to change our rating from a buy to a sell, we can look at it both qualitatively and quantitatively. Qualitatively, like all those risks that we talked about, especially the pricing pressure from companies like Walmart, if they're falling into that too heavily, we can see why we would need to revalue their company and possibly even change it to a hold or a sell. Also, all the other risks that we talked about. Quantitatively, if it got, since we even did this, it's already gone up. Their stock price has already gone up 4 points. If it got above our stock price, we'd obviously have to revalue them because at that point we're saying that they're overvalued. So we'd have to revalue them to see if we can expect an even higher growth rate or not. But so the main things we would be looking for is whether those risks are coming to fruition and how their stock price is changing over the time.
Right. Good answer. Thank you.
Can you talk a little bit about management, quality management, what they do to attract and retain talent to come to Allegan, Michigan?
I think some of the big strengths is just their strategy, the first and last in. They've really spent a lot of time, I think, trying to develop that system and make it really work, and just find the people to teach them the system, to get them to learn it effectively and to officially utilize it as well as they can, and just find the best and brightest to keep working for them and get people to understand that they're a very broad company, that they are in a lot of areas, and just how to make a company that big really work as a whole.
How they incentive management of that acquired companies to continue to work, or do they retain management when they acquire companies?
Sure, I can take that. They retain management by offering, aside from compensation, a lot of stock options. Like if you look at the major holders of Perrigo stock, their CEO owns just himself 1% of their stock. He owns about 111,000 of the shares. And another thing that they do is, it's an exciting company. They're innovative. They, like I said before, they love getting into the newest things, which is key to like any generic manufacturer, because they don't have brand name recognition. They need to have a diverse product line. They need to be very adaptable in any business climate. So I think Perrigo is always doing these new kind of acquisitions. They're always developing new things, and that's what really makes them dynamic, and it makes it a great place to work too.
You had mentioned that in moving API facilities from Israel to India, that they would retain the Israel facilities, possibly produce more complex ingredients.
Yep.
What's your view of the opportunity there?
Well, I think that way, with their highly leveraged balance sheet, they'll be able to start making more products that other companies won't be able to.
You can finish.
Okay. And they'll be able to keep making products there, but as well as diversifying everything to keep their costs lower. They'll have more room to get into the industry so other people won't. So they'll be able to hold their market share with those APIs that other companies won't be able to. So keeping their costs lower by being able to buy them themselves, and then also making the margins on the high demand when other companies won't be able to.
Thanks.
Thank you.
Yeah, thank you.
Thank you.
Thank you.
Thank you.
Thank you.